The basis in silver is showing increased scarcity of metal, for whatever that may be worth. We calculate a fundamental price in silver of $40 right now. What we're measuring is how much metal is being offered to the market. And so somebody, obviously this price of silver is up, somebody's buying it, and they're buying physical metal, right? So we're trying to measure how much of the buying is futures, which people can do with 20 to 1 leverage, and how much is physical. And the difference is that when you buy something with 20 to 1 leverage, you have to sell it fairly quickly. Either the price goes up, hits your target and take profit, or the price goes down and you hit your stop and you're out. But that's not a long-term, it's not a durable position.
Silver's rising basis indicates growing physical scarcity, suggesting strong demand for actual metal rather than just futures. Analysts estimate the fundamental price of silver to be around $40. This scarcity signals that buyers are increasingly opting for physical silver over-leveraged futures, which are typically short-term trades. Unlike futures, physical purchases tend to be longer-term and more durable, reflecting more profound conviction in silver's value. Total global silver supply is forecast to grow by 3% in 2025 to an 11-year high of 1.05 billion ounces. Keith Weiner, founder and CEO of Monetary Metals, notes that silver is becoming increasingly physically scarce as evidenced by prolonged deficits, shrinking inventories, and unusual price dynamics, including backwardation. With booming industrial demand, especially in green tech, and growing investor interest, shortages are likely to persist, making silver a compelling candidate for further price appreciation. More people buy and physically hold the metal instead of trading futures. Physical purchases remove silver from circulation for the long term. Unlike leveraged futures, which are short-term trades, this trend is visible in market spreads and may push silver's price toward its calculated fair value of $40, or even higher, due to potential overshooting. The speaker warns against leveraged silver buying, but sees signs of growing investor interest as silver looks undervalued relative to gold in a tightening market. Despite headwinds from a firmer dollar and rising treasury yields, investor sentiment towards silver has improved in the early part of 2025. This largely reflects several macroeconomic and geopolitical risks, which have continued to underpin inflows into safe haven assets such as silver and gold. The recovery has been assisted by short covering by tactical investors in the futures market amid fears about President Trump's tariff plans and a subsequent spike in futures and spot silver prices. Looking ahead, uncertainty over U.S. trade and foreign policy, record-high U.S. equities, and worries about U.S. public debt levels should all reinforce interest in portfolio diversification, which in turn will benefit silver and gold investment. Moreover, even if the pace of U.S. policy rate cuts slows in 2025, the consensus remains that they are forthcoming. Coupled with sticky inflation, this suggests potential declines in real interest rates ahead. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update.
What we're measuring is how much metal is being offered to the market.
Right.
And so somebody, obviously this price of silver is up, somebody's buying it, and they're buying physical metal, right? So we're trying to measure how much of the buying is futures, which people can do with 20 to 1 leverage, and how much is physical. And the difference is that when you buy something with 20 to 1 leverage, you have to sell it fairly quickly. Either the price goes up, hits your target and take profit, or the price goes down and you hit your stop and you're out. But that's not a long-term, it's not a durable position.
Right.
When you buy metal and you take it home and stack it, it's usually, you could have a life event that forces you otherwise, but usually you're taking it home and taking it out of the market for some much longer period of time. And so that's what we're trying to measure. And right now, somebody or several somebodies is buying physical metal and taking it home. So metals become scarcer to the market. We're seeing that in the spreads. Obviously, we've seen that to some degree in the price. If our indicators are right, we'll continue to see that reflected in a price as the price continues to move up. We'll see a four handle if that's true. Could go beyond that. First of all, buying can beget buying, especially in this kind of market. And then secondly, when something is stretched that far from its fundamentals, it doesn't usually, if you pull, if there's a rubber band, with tension on it and you let it go, it doesn't just go like this. It will often overshoot. I remember saying this in interviews in it would have been, I don't know, 2014 or 2015 or 2016.
Okay.
And silver it come down obviously off of its big high. I want to say it was $23, $24. And the fundamental price was way below that. And I said the same thing. I said, if it stretched that far, it's not going to come down to flat. It can overshoot. And if it does, we could see a 12 handle on silver. I got hate mail for that.
Really? No way.
Guess what? Guess what? We saw an 11 handle
Right.
on it. And so that overshooting is a real phenomenon. Now, one of the people who sent me the hate mail actually sent me, not exactly a love letter, but kind of an apology after that happened. And he said, boy, were you right.
Right.
That, and I say I'm not predicting it. I'm just saying if it was as far stretched to the downside as it is currently stretched to the upside, this is what you'd see.
Right.
And, it turned out it happened in that particular case. So right now it's stretched to the downside and it should go up to 40 and perhaps beyond. Now, I'm not telling anybody go buy silver with leverage. That's a dangerous thing to do. I certainly wouldn't recommend to do that. I can only call and say, and this is all these graphs are available for free on our website anyway, monetary-metals.com. Everyone can see it and track it. And this is what's going on. But yeah, the silver market got tighter. Probably somebody said, well, gold's expensive. I mean, this has been the logic for years.
Right.
Gold is so bloody expensive. The price of gold has moved up so much relative to what silver has done that silver is the relative buy. Okay, well, theoretically true in the abstract, hypothetical. Does that mean anybody's going to buy silver? They still prefer gold anyway for all the reasons why people prefer gold.
Right.
Now, somebody may be acting on it, and the silver market's a smaller market, so it doesn't take as many people acting on it. And, there it is. The rising price of gold combined with a more and more inverted spread, that spot gold that is cash on the barrelhead for real metal, much, much higher and rising relative to futures price gold or paper gold, that will totally divorce in the end. And that permanent gold backwardation, through a mechanism I describe in my paper, will cause, people will call it hyperinflation of all the commodities. Although it won't be anything to do with the quantity of dollars, but people will call it hyperinflation and then at some point stick a fork in it, dollars done. And this will be a calamity akin to 476 AD, like really, really horrific. That's what I predicted in, something I wrote. When did I publish When Gold Backwardation Becomes Permanent? I want to say 2010, it could have been 2011, somewhere back there, 15 years ago-ish.
Right.
And I don't see anything having changed since. They have to play more and more games to juice up more and more debt to get diminishing returns, with more and more people are marginalized out of the workforce.
Right.
So if you look at the not counted in the workforce statistic, that continues to rise. The percentage of zombie corporations, I'd love to see that number now. I have not seen it updated in a long time. Before Powell was hiking rate, 20% of all corporate debt was so-called zombie debt.
Right.
And zombie means when your profits are less than your interest. So you have to pay the interest when you have debt, and the interest has to be paid out of profits. You have to make money in order to be able to afford the interest.
Right.
And when your profits are less than your interest expense, you literally can't even afford to service. Imagine when your salary is less than your credit card debt.
Oh, yeah, you can never pay.
I'm sorry, no, not less than your credit card debt, excuse me, less than the interest on your credit card debt.
Oh, that's
So you're
crazy.
sinking deeper and deeper, even if you're putting all of your money towards servicing that debt. So that was 20% of all corporate debt was zombie before interest rates went up. That was at zero.
Jeez.
And then he hiked it to 5%, surely a much, much larger percentage of corporations, drowning deeper and deeper and deeper in debt.
Wow.
So, I use the analogy of if hyperinflation is kind of hot, like a nuclear bomb going off, 15 million degrees Fahrenheit, debt is more like a cold death. It's kind of like drowning in the deep sea. The water's cold, and the deeper you sink, the colder it gets, and it's dark. And eventually, the last breath is crushed out of you, and
Jeez.
and that's where this thing is headed. So yeah, buying gold affords you options that if you don't have gold, perhaps you don't have. But if the whole society is collapsing, that gold, and this was the bleak message of that paper, it's better to have the gold than not, but that gold may not avail you, in the end. And so the founding idea of monetary metals is, can we avert permanent gold backwardation? Can we bring gold to market, in a way that serves the self-interest? Because that's why gold will be pulling out of the market. It's the self-interest of the gold owners. Can we pull it into market by serving their self-interest? And if so, then we can avert this disaster.
Yeah.
So that's what we're about.
Absolutely.
Ideologically.
Keith Weiner criticizes the U.S. debt ceiling as political theater, noting that it's been raised over 70 times and no longer serves a real purpose. At the same time, removing it entirely would only encourage unchecked debt growth. Both political approaches to managing debt are flawed. The core issue is that the debt must continue to grow due to the system's current structure, which is why people are turning to gold as a hedge against inflation. While gold might dip occasionally, demand remains strong, keeping dips shallow as investors wait to buy. Overall, the market shows steady fundamentals despite price volatility. The silver market is forecast to record another significant deficit, total supply less demand, for the fifth consecutive year in 2025. In line with previous years, silver industrial demand will continue to be the key driver of this favorable supply and demand backdrop, with volumes projected to reach a new record high this year. Concerns about President Donald Trump's anticipated tariff policies have fueled short covering and deliveries of silver and other precious metals into CME warehouses since late 2024. This, coupled with rising economic and geopolitical uncertainties, has underpinned a healthy recovery in silver prices since the start of 2025. Interest rates must eventually fall because businesses can't sustain profits with current borrowing costs. The Fed is resisting this, possibly for political reasons, but the speaker believes rates will fall either due to a credit crisis or a leadership change at the Fed. Ultimately, the system is broken, and more people are buying gold to hedge against this reality. Now, let's dive into the interview.
Did you ever watch a sports game and you're like, I wish both teams could lose?
Yeah.
Because I hate both of them. They're both dogs. The idea that there's a debt limit is absurd because the debt has to necessarily, because of the nature of the monetary system, grow exponentially. It doubles about every 8 years. So in that sense, the idea of a debt limit is just pure theater. It's pure grandstanding opportunity every time it comes up.
Right.
And in that sense, it serves no useful function other than as a platform of grandstanding and political finger pointing and all the rest of that. But at the same time, to get to the point where we're so, I'm not even sure what the right word is, a nerd maybe, to be a little bit technical. We're so jaded and so cynical about the debt. We're just so blasé. There's that breezy hand whip. Just get rid of the debt ceiling already. I don't really like that either because that just says embrace the exponential growth of the debt.
Right.
Versus the other side that says let's pretend that we're still under control with the debt. And both sides are wrong, and I wish both sides could lose. But the debt's a problem. The debt limit, so-called, has been raised, 70 odd times?
Jeez.
I mean, so anything that can be raised at will by politicians 70-something times is a joke. It's meaningless.
Right.
So in that sense, get rid of it. But then getting rid of it is a whole political ideology that I don't like. For lack of a better word, we'll call it modern monetary theory. Before that, we called it Keynesianism, and before that, we called it chartalism. These are not new ideas,
Right.
that you can borrow your way to prosperity. That's what we're doing. So that's why you want to wonder why gold is in this bull market. So maybe it's because more people are realizing they want to hedge against, this isn't going to any good place. And, PhD economists can debate the precise failure mode, whether it's hyperinflation, whether it's deflationary collapse, whether all these things, right? That can be debated, but clearly it doesn't end good, doesn't end well. And so people are, yeah, buy gold, right? Obvious, it's the obvious trade. And so that's what's happening. And, we have a dip in gold, but not very much of one. And every time people ask me, is this still a bull market? I'm like, yeah, but there'll be dips along the way. And they always want to know, like, okay, but where's the bottom of the dip? Should I buy 2,800? I'm like, yeah, if you see 2,800 buy, I don't know if you're going to see it. And the reason why dips in a bull market are usually shallow is because everyone is waiting for the dip to buy. So that becomes a self-fulfilling thing. And, the other guy may buy a couple of pennies ahead of you and you don't get filled on your limit order. I don't know where it's going to go.
Yeah.
Anybody who pretends otherwise, I look at the basis, and in gold, basis has been almost table flat, not really going anywhere.
Right.
So if it's not going anywhere, then the market's pretty steady, and the price action is almost essentially noise. It can go up and down and move all over the place. It's the same thing as it ever was. And I've been saying since about 2010, about 15 years, that the debt keeps doubling about every 8 years. And every time, every day it's hitting a record new high. It doesn't go down, right? It only goes up.
Yeah.
Oh my God. Look at these Bush deficits, $400 billion. It's pretty cute now, right? Oh, only $400 billion.
Right.
It gets worse and worse and crazier and crazier. maybe we're at the point where it's more obvious to the mainstream people that 36, $37 trillion is not something that the American taxpayer could ever hope to repay. Whereas previously, people would do that breezy hand wave. I love that breezy hand wave. Whenever somebody does that, pay attention because they're trying to, obscure something that's important or much bigger deal than it really is. The
Right.
breezy hand wave, oh, well, once the economy gets on a sounder footing, we'll pay it off. Maybe we're at the point where it's more obvious to the mainstream that 37 trillion divided by perhaps 100 million, people that are working in the private sector, $370,000 adults working only in the private sector. So people working for government obviously can't net pay the debt. They may work hard and they may do something valuable, but they're not net payers.
Right.
Only people working in the private sector can be net payers. $370,000 per person, married couple, $740,000. Did I do my math right? Yeah, 740.
Yeah.
I just didn't want to embarrass myself there. It's obviously hopeless that the average people don't have the means on top of their share of their state debt, their city debt, their county debt, their municipal water district debt, fire, sewer, library districts. And then on top of that, they have business debt, corporate debt, personal debt, auto, home, student loan, credit card.
Yeah.
Right. So it's clear that this is, debt that's never to be repaid. I'm not sure that makes much of a difference, like how the market's going to work, but people are like getting excited about it, which is good, I suppose. They
Yeah.
start to think, okay, there's a problem. What's Alcoholics Anonymous? The first thing they tell you, you have to be able to say, you have a problem.
Right.
For the whole time that you're in denial, you still have to find that gutter to fall into. When you finally hit the gutter and you can say, hi, my name is so-and-so, I have a problem, I'm an alcoholic, it's the first step. You're not cured yet, but I think the Fed is actually fighting the tide and trying to hold them up. Would have lowered them, but Trump ordered Powell to lower rates. And I read it, and I try not to get into the people side of all this and the political side of this because
Right.
conclusions about politics are difficult at best. Conclusions about monetary science are scientific conclusions, and one can have a certainty of certain things. But I read it as Powell is trying to demonstrate that he's not Trump's, poodle, and I'm not going to take orders. The Fed is independent, et cetera, et cetera. So he's trying to hold out as long as he can. And one of two things is going to happen. Either he's going to be forced by some sort of credit crisis to lower rates. His term comes up, as I understand it, next year, and Trump is going to name somebody as early as he dares to try to maximize the lame duck, period where Powell will be, irrelevant and sidelined even before he leaves office.
Right.
And so one or the other, I think rates are coming down either, later this year or early next year.
Silver's growing physical scarcity, combined with continuing industrial demand and mounting macroeconomic pressures, all point to an optimistic outlook for 2025. With deficits persisting and investor preference shifting toward physical silver, the metal's fair value may soon be realized or even exceeded, particularly if confidence in the U.S. monetary system erodes. Meanwhile, mounting geopolitical risks and concerns about the sustainability of U.S. debt are prompting more investors to consider precious metals as a long-term hedge. How will sustained silver shortfalls and investor behavior affect long-term price stability? What impact could falling interest rates have on silver and gold in comparison to other asset classes? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates.